A double top in the Dow suggests that this big, huge rally that we've had over the last few months may be getting exhausted and nearing an end. Seasonally, stock markets tend to have their strongest time in the year between about the middle of October and the middle of May, with the middle of May to middle of October often being a very more volatile and choppy time of the year for stocks. This year, the beginning of the seasonal rally coincided with the U.S. election on November the 8th. People had kind of held off for a few weeks, waiting to see what was going to come out of the election. Then once we had a decisive winner, we saw a lot of pent-up capital coming in from the sidelines, plus we had a lot of expectations that President Trump would come in, wave his magic wand, and that all would be well and right with the U.S. economy once again going forward. Now, as we've moved into 2017, certainly we've seen that changing and reform is a lot more difficult politically than people had expected initially. However, we had seen that positive corporate earnings had helped to kind of hold up the stock market so far. But as we've moved through the main part of this earnings season, we're getting very strong results, and they're having a positive impact on selective stocks, but we're not seeing the index going to new highs anymore. We actually had the peak in the market. The first peak was on March the 1st. This coincides with the deadlines for a lot of retirement savings plans for tax purposes in the US, Canada, the UK, and elsewhere. So this seasonal inflow of money that we got in February has kind of faded. We've seen the markets fade a little bit. We've had a little bit of a run up here after the French election results and on corporate earnings, but look at this. It's running into a wall here in and about 21.25, 21.30. We've got a double top forming. We're now moving into the back half of earnings season. If stocks aren't going to blast through to new highs now, they may not for some time because the news flow is starting to dry up. Meanwhile, the economic news flow hasn't been all that great either. We've seen a spike in the what they call soft data survey results. Things like purchasing managers and some of the regional reports had been running very high following the election. But we're getting mixed results from economic figures. In particular, today we had the U.S. GDP come out, only 0.7% increase over year. In fourth quarter, it was 2.1. So they were starting to see a slowing. We're seeing a real slowdown in U.S. consumer spending. There's been talk of the retail apocalypse, that there's been 75,000 jobs lost in U.S. retail and stores closing like crazy as the whole retail sector readjusts to the online world. There's a lot going on. There's a lot of turmoil and transition in the U.S. economy that hasn't really been borne out in U.S. stocks at this point in time, and it's really starting to look like the U.S. stock market may have gotten ahead of itself. On top of that, one of the few areas, and we'll see this play out over the next week or so, is that the areas that are successful, have remained successful, are what we call late-stage areas, things like technology stocks, things like employment. These are the areas that tend to do well towards the end of a cycle rather than at the beginning, and they're the areas that are doing really well right now, which is also an area of concern. But looking specifically here at the U.S. stock market, we can see if we look at these trend lines, there was one initial steep trend line here has been broken, a more shallow trend line has been broken, and then you're starting to develop more shallow trend lines moving your way down. This trend is going from a strong uptrend into a sideways trend at best and could roll over. We're also seeing this here in the RSI. We had a massive double top in the RSI, but since then upward momentum looks like it's peaked and started to roll over, and we're starting to see this lower high in the Dow, even this for a while lingering below 50, now rolling down from a lower high. Double top up here. Overall, this is a sign of a market that's looking exhausted and ready perhaps for a seasonal correction, particularly should news flow dry up or should we see more negative economic news start to come out. Something else that's important to consider also is what's going to happen with the Fed in the coming weeks, because now the Fed's finding themselves stuck between a rock and a hard place. The U.S. economy is slowing, but inflation is accelerating, and now what do? They need to raise rates in June because there's a high risk of a government shutdown in September. The current negotiations are designed to kind of kick the big battle off to the fall. So we could see quite a bit of volatility as we move through the seasonally weaker time of the year for stocks that runs between pretty much now and the middle of October. So right now we've seen the Dow has drifted back under 21,000. First support is this recent lows here around 2375, 2270, is a 23% retracement of the Trump honeymoon trade as well. As we move over now, we'll also look at not only is the Dow failing, the S&P is starting to falter as well. Same thing, a double top forming here, and look at this little shooting star candle that popped up into a test here, failed at 2400, coming back down. We're having a couple of fairly flat days, but overall, we come down here, look at the RSI rolling down from a lower high. Overall, this doesn't look like a market that's picking up momentum. It looks like a market that's topping out and losing momentum. As I noted, the one market that does have momentum still, though, is the Nasdaq. But as I noted, the Nasdaq is dominated by technology stocks. It's a late cycle play, and you saw this back in 2000 where the Nasdaq kept on going after the Dow peaked and then eventually rolled over, and now we're starting to see the same sort of thing. The Dow and the S&P peaking, the Nasdaq has continued going. Technology is considered to be a late cycle sector. It's companies that do well towards the end of the cycle. We saw spectacular results from Amazon, from Google, from a number of other tech companies coming out. They've benefited the Nasdaq, but they're not really benefiting the broader indices. This rally is getting contained into smaller numbers of companies and smaller numbers of sectors. The breadth is weakening, also a bearish sign. So we're seeing here, on the back of all those positive reports from Google and Amazon and others, we're not getting the uplift we saw before the results. We're getting a doji candle. That's telling us bulls and bears are coming into balance, and that the bulls are probably, this big rally has already priced in some of these big earnings reports. We've got the RSI overbought, suggesting we're vulnerable to a correction here. We've got a negative divergence telling us upward momentum is slowing as well, which is becoming even problematic for the Nasdaq that's been doing well. So we're watching here, 5600 has emerged as initial resistance here, 5535 first support, followed by 5500 and this breakout point back here around 5450 in an initial correction. So far, the broader uptrend remains intact for this index, but it does look as though it's getting tired and could be vulnerable to a correction in the short term. So the other thing we're watching for in the coming week is we've got the Fed meeting, we've got more earnings, and of course we've also got ADP and non-farm payrolls. I note again that employment is one of these late cycle areas, but the last month non-farm payrolls was disappointing. The street's going to be looking for a big rebound this time, and if we don't get it, that could be have an impact on trading in stocks as well.